Hey, it's Richard with Matthews Wealth Management doing a market update for the month ending in October. Now, to be perfectly honest, it's mid November right now, and I'm just getting to it, so I kind of already know what's happening. But we'll rewind and kind of look at this from the end of October back. So it was actually a very interesting month. When you look at October, we have large caps across the board are actually down in the month of October there, and the way we would expect actually, where we're only down 2.7 in value, and then that increases the more we get to growth. That's actually a normal correlation. That's what we were expecting on our last rebalance back at the end of August, around that time frame. We rolled more towards the value side, hoping to plan against something like this. Mid caps, we kind of have an up and down and up type picture there, and small caps actually had a very good month for October. International and emerging markets, that's a little bit opposite from what we would expect. We're down 4% on international, but up 2% in emerging markets. Tips and bonds predominantly are just down for the month, and that's been an interesting twist when you're looking at large cap drop as well. High yield bonds were actually up. So we've had a very consistent year for high yield bonds, which is not typical in a volatile market like we're experiencing. So that's been a little bit of an outlier. Real estate is down 3%. A lot of that, I believe, is going to be inflationarily speaking. The investments into real estate won't be necessarily as profitable as we look to not having increasing wages and income, but having higher expenses on things like lumber and so forth. So jump into gold. Gold is down. Oil is down another 11.6. So oil took a big hit in the month of October there. So for overall S&P 500 down 2.66%, and overall for a moderate type risk, which we look at through the Dow Jones benchmark, is down about 0.5%. So let's rewind and take a look at the 3-month prior to the end of October. Value was down. Growth was up, and that was the trend we had seen since COVID hit in February, March timeframe. That big crash, since that crash, we've seen growth come roaring back and see the value just continue to fall off until recently. So we see the same kind of picture we saw in small caps in the 1 month. We see that also in mid caps for the 3 months. Same thing again for the small caps on the quarterly. International and emerging markets, the same trend, down, up. And then we start to see we have some kind of gains in the world of bonds. We're in such a strange interest rate environment right now with enormous amounts of liquidity as far as cash on the sidelines as well as bonds being issued. But we can see that the shorter term and the inflationaries are up, and we're having a big sell-off in long-term bonds. A lot of that has to do with demand into the growth world. But we'll save that for a later time. Then high yield, kind of keeping the same picture there. Real estate down 5% on the quarter. Looks to be accelerating if we look at the 1 month. Then we see gold down 5.3. It's strange in inflationary pressures, but that's what we're seeing at least for that quarterly. Oil down 13. Again, the bulk of that was taken in the most recent month. But the S&P edges out a little bit of a gain. Dow Jones moderate, a little bit of a gain too, and we can kind of see that there's more black on the board than red for the 3 months. Year to date, we're going to have kind of the story of the year. So if you were to go back in time to January and look at these asset classes and say, how do I want to invest in the year of COVID and the year of the election, you still probably would have gotten it wrong. It's just been something for the history books. We're still down 15% in large cap value, 18% mid cap value, 21% in small cap value, and that's usually the backbone of a stable portfolio, if you will. And they've gotten hammered. On the flip side, we're up 22 large cap growth, 23 in mid cap growth, and 15 in small cap growth. So the risky ones are making a fortune. The safe ones are losing everything. So it's been a crazy year there. International's down 10% as well. Still up on emerging markets. And look at these bond returns. Now, the majority of these bond returns were brought on earlier in the year, obviously. You can tell over here. But we're up 12% since January on long term, 5% intermediate, 3 and 8.5 on Treasury and inflation protected securities. So that's a big number right there. High yield still flat but stable. And then we see real estate's down 14.5% for the reasons I kind of mentioned before. Gold is still up 20%, so inflationarily, that's usually what that would signify. Then we have oil back down 70. I think in the last one we were down 40 or 50, something like that. But we've had these big sell-offs here recently in oil. So S&P is only up 2.7. Dow Jones moderate, only up 0.5% for the year. So if you were to compare all the moderate portfolios across the country, this is what we're dealing with. So even if you see people doubling their money in Apple or Alphabet or whatever it might be, this is what the majority of people are making this year. So let's talk about Matthews Wealth Management, our year-to-date practice. We have the best, this is the best short term, where we're up 26.5%. Our best long term, which would be a client that we've had over the years, didn't come in during the COVID crash. They're up 18% on the year. Worst account that we have is down 13 since January, and our average is 1.37%. So overall, we're kind of in the world of moderate. That's why we use this benchmark for looking at a whole practice. Each client's very different and very unique in how we build the portfolios and the allocations, but it's all the same basic types of investments that we're looking at here. So how do you mix them? What did you see coming? What moves have you made through the year? And we've come out on top doing pretty well, 1.37 overall. So come back to us next time at the end of November. Should be interesting, and we'll see you then.